Welcome to Investing Tutorial Channel, where we delve into critical topics shaping our world today. The possible outcomes and repercussions of an imminent collapse of the U.S. market will be discussed in this video. Join us as we journey through the complexities, offering wisdom and insight. The specter of a market collapse looms large, raising concerns and uncertainties. In this deep dive, we aim to shed light on the factors contributing to this scenario and the possible ripple effects on a global scale. We begin by dissecting the current economic landscape, identifying key indicators pointing towards a more severe downturn in the USA market. From fiscal policies to market trends, we leave no stone unturned in our quest for understanding. Explore with us as we discuss the underlying catalysts that might amplify the severity of the collapse. From geopolitical tensions to internal economic challenges, we break down the interconnected web shaping the trajectory of the market. Drawing from historical precedents, we draw parallels to past market collapses and analyze the lessons we can glean from them. History often serves as a guide, offering invaluable insights into navigating the turbulent waters of economic downturns. A collapse in the U.S. market would have an international impact. Come along as we examine the possible worldwide effects and evaluate how this event could affect trade relations, international economies, and geopolitical dynamics. Gain perspectives from leading economists, financial analysts, and experts in the field as we incorporate their insights into our analysis. Diverse viewpoints provide a holistic understanding of the multifaceted nature of the impending market collapse. In my opinion, the state of the economy is dire. Though he isn't entirely to blame, I believe that a large portion of the public blames President Biden for their economic difficulties. He hasn't done anything to improve everything, though, which is one of the reasons I believe he is so unpopular. In fact, what he's done is taken a poor situation and made it worse. However, if you examine the facts with objectivity, the savings rate is at its lowest point since 2007. It is, I believe, down to 2.3%. Americans are now essentially bankrupt after spending all of their stimulus money. The amount of debt on credit cards is at an all-time high. Because they are finding it difficult to pay their electricity and food bills, Americans are taking out greater credit card debt. In actual terms, salaries are dropping, and I believe that this decline is being concealed by the fact that inflation is being understated. I believe the true rate of inflation is almost twice as high as what the government will acknowledge, which implies that real wage declines are far more significant and explains why so many people are experiencing them right now. An unprecedented number of Americans are moonlighting. In fact, more Americans than ever are working full-time jobs. Most people would prefer to be able to support their families and themselves with one job, but in the current economic climate, that is not possible, which is where all the newly created jobs are going to go, to those who don't want more jobs, but who are compelled to accept them nonetheless because it's the only way they can keep up with the growing cost of living. These figures are highly misleading, to put it nicely, since the implication is that about 260,000 people who were unemployed before now have jobs, which isn't the case. It's not a fantastic economy, and all of those jobs went to people who were previously employed. They are part-time employment, where those with jobs would prefer to have two jobs in order to have more leisure time and be able to spend more time with their family. But regrettably, they are unable to pay for it. So if someone wants to leave retirement, they must find another work, which is where these positions are coming from. Let's take an example where a 70-year-old retired person was excited to spend time with their grandchildren, play golf, and visit the beach. However, as there is now no other way for them to pay the grocery bill, they must go obtain a job at Target. Do you want to take pride in having created an economy where those without jobs are compelled to return to the labor, and where a large number of individuals who are not employed are not included in the unemployment rate, which is the primary cause of the low rate of unemployment? More than 100 million people of working age in America are no longer employed. However, I'm sure that a large portion of those in attendance are just dejected employees who feel that they don't matter if they have all but given up on finding employment because they don't believe there are any positions available that meet their qualifications at a pay that will allow them to accept the position after a year. You are not included in the U6 number, which also excludes part-timers and discouraged workers, although they would want to work full-time, and those who are still searching for full-time work but are having difficulty finding it. I believe the unemployment rate is closer to 7%. Yet even that jobless rate after more than a year of discouragement. Additionally, you are no longer included in that total. Therefore, I think if you objectively examined the unemployment rate and included all the folks who are not working, however, who would be employed if they thought they could find employment, or who has opted for a part-time position when they would have preferred a full-time one, the real unemployment rate is probably in the double digits. Once more, the savings rate is 2.3%. That is the most recent figure that the administration disclosed last week. Since 2005, savings have not been this low. However, in 2005, Americans were able to save so much money because they were able to capitalize on the real estate bubble, which was at its height. Now, however, they are losing their home equity as prices of real estate are declining. This is concerning because real wages are also declining as a result of rising living expenses and credit card debt. Therefore, credit card debt would not be skyrocketing if Americans actually had all this savings. People are borrowing money to make purchases because they lack savings and cannot afford the items they want to buy, which is the reason credit card debt is rising so rapidly. The amount of national debt is increasing. Despite the ongoing global conflicts, all of the big banks are projecting significant rate reductions during an election year. Donald Trump issued a warning, claiming that it would be the biggest defeat in 2 centuries if the US dollar was no longer the accepted global currency. The good news is that anyone may profit from this circumstance because there is a clear correlation between the world's most astute investors and their success in adding physical gold and silver to their portfolios. However, a larger portion of the money they are borrowing is being used for gas and electricity rather than food. Look at all the major retailers who say that their customers are spending more money on food and less on other expenses because food is so expensive. The credit card situation is also frightening because most people are the ones who use their cards excessively, which is a sickening feeling. I believe that people with large credit card debt are purchasing necessities rather than putting them on credit because they lack the funds. It makes their stomachs turn to watch their bills mount up and their interest rates rise, which I can only assume would make them feel somewhat enraged at the Federal Reserve. You know, every time one of these rates is raised, you end up with more debt. For example, credit card rates are currently about 20%, which is a significant amount of interest to pay. In addition, I believe that many people in today's society have debts other than credit card debt. Due to the rise in buy now, pay later organizations over the past few years, people are exploiting those businesses to make purchases without having any money. However, although it's not credit card debt, it's still debt that the customer must repay, and I don't think they will be able to, so it doesn't appear in the credit card numbers. It looks unavoidable. There is a credit card default catastrophe that resembles the housing crisis you mentioned in 2005. And you wonder what will happen with all that credit card debt when the housing collapse occurs in 2008. Indeed, as you are aware, credit card debt is not secure. If you don't pay the credit card company, you are aware that they are unable to seize your assets, such as your home or an IRA. We haven't noticed a significant increase in credit card delinquencies. The debt is dischargeable in bankruptcy and is very difficult to collect if the individual doesn't have any money. I believe it will happen in 2024, though. Another thing that happens to people who have credit card debt is that once they realize they can't pay it back, they either decide not to pay it back or declare bankruptcy. Initially, they will simply borrow as much money as they can and max out their credit cards. Since they are getting free goods for their purchases, if you have $50,000 in credit card debt and you intend to file for bankruptcy, this is a factor to consider. However, you still have $50,000 that you can borrow. So you're going to spend the remaining $50,000, go shopping, and acquire as much merchandise as you can because, should you declare bankruptcy, you won't be required to return it. For example, you could go on a trip and purchase a ton of clothes and electronics, then file for bankruptcy. You are not required to return any of that items, and it makes sense to purchase as much as possible before filing for bankruptcy, because you won't be able to obtain new credit cards for a period after you file. Hence, before you go bankrupt, you might as well acquire everything you can. Moral hazard results, which will cause the banks issuing the credit to lose money more quickly. Tell me why Jamie Dimon and others are predicting an impending recession when the Federal Reserve is taking all necessary steps to avert one, and why layoffs are occurring at companies. I'm not even sure if they have a plan, but I believe we are already in a recession, and rate increases are partly to blame. Even if I believe that the recession will only get worse from here, the Federal Reserve should still be hiking rates. They should have done so much sooner. Cutting rates and then raising them again is essentially an admission of error. The problem was that they never should have cut them in the first place. However, when the Federal Reserve hikes interest rates, it exposes all of the issues that it caused when it lowered them. This is because the quantitative easing program, which expanded an already inflated bubble economy, was implemented when interest rates were cut to zero. Inflation, it is merely another term for description. Simply because inflation has a negative connotation, many individuals are unaware of it. If the FED stated that their goal is to induce inflation, quantitative easing wouldn't sound quite so horrible. Wait a minute, I don't want inflation, the public would have replied. Thus, you won't have as many opponents of the idea if they claim that their policy is quantitative easing. However, the effects of that inflation are now being felt by us. This is one of the reasons why there is still a long way to go in terms of rising pricing. I believe that the recession will worsen significantly because more consumer money will be allocated to necessities like food, energy, rent, insurance, and the like, and interest rates will need to continue rising, which will further reduce the purchasing power of the economy. Because debt must be paid back, and paying interest on money borrowed to make purchases in the past reduces the amount of money available to make purchases in the present and the future, which contributes to a more severe recession. The majority of individuals who own stocks regrettably possess the most overpriced equities. Big tech, for instance, which are the ones that increased the most since interest rates were zero and people believed that inflation would remain low indefinitely. As a result, most people's stock portfolios will continue to decline. Now that inflation has arrived and is only growing worse, interest rates are not zero. Even if those stock values are declining, I believe they still have a ways to go. Most stock market investors will experience financial loss. Despite the increased rates, I believe they will fare even worse in the bond market. People will lose a lot of money on bonds because they are now not quite high enough to offset inflation. As a result, they must begin to think outside the box and consider different investment strategies. You can still invest in equities, but not in overvalued indexes. In the case of technology names, you must use greater caution when selecting equities. You have to select the stock based on value and dividend yield, and then build your own portfolio rather than merely buying these indices. And I believe the finest deals are available abroad. I believe the highest dividend yields are found outside of the United States. And I believe this also provides you with a hedge against what I believe will be a very weak US dollar. The dollar is up for the year, but it is rapidly losing those gains. And I believe that over the next several years we will see a very weak dollar as markets come to terms with the fact that inflation will not only rise, but will also continue to rise. But it's here to stay. It's not going back down to 2%, and that's going to cause a run on the dollar and US dollar denominated assets, especially if the Federal Reserve has to return to quantitative easing, which is causing more inflation because the economy has deteriorated to the point of financial crisis. And now the FED is under a lot of pressure to revive the economy, but the only way to do so is to create even more inflation. Just to point out, the positions that are being lost are full-time, high-paying jobs with benefits. We're generating part-time jobs with little pay and no benefits, so there's no trade-off between the jobs we're losing and the positions being created to replace them. However, I believe that this is just the beginning of the layoffs. I believe that there will be a large number of layoffs. In fact, some businesses will fire all of their employees in order to avoid going bankrupt. However, Many businesses will fire a large number of employees in order to avoid going bankrupt because they must start cutting costs. And one cost that they can cut is labor. When you cut labor, you have to fire employees, and the decline in businesses' actual sales is the cause of this, since their clientele are impoverished. Consequently, consumers are unable to purchase as many items, which means that businesses that sell them will require fewer employees to support the supply of goods and services, and employers will have to pay higher borrowing rates in the event that they have taken out a loan. Many firms have done so to purchase capital equipment, which means they may have to pay more for office space and other raw materials. Therefore, they must find a way to turn a profit. Since companies must turn a profit in order for its owners to profit from their venture. Reduce staffing. Reducing headcount is one strategy to scale back a business, which will be implemented throughout the economy. Businesses that don't make a profit must find a way to make one, or they risk going out of business. And naturally, there are a lot of businesses that were only established as a result of the low-cost monetary policy and the atmosphere of a casino. Businesses that never should have been founded in the first place, that the Federal Reserve established on the stock market, many of which have never turned a profit. However, they employ a large number of people. Thus, they were able to pay their staff by selling investors' stocks. However, many of these businesses won't be able to survive if the market for money-losing ventures shrinks. If they do, it will only be if they can drastically reduce their operations and turn a profit, which most likely requires them to fire the majority of their workforce. They have to decrease because, well, most Americans who purchase a home do so through a mortgage. Most of them lack the funds to do so, let alone for a down payment. Historically, the typical down payment was 20%, but it is currently closer to 5%. They have to go down because, when people buy houses, the great majority of Americans do so with a mortgage. They don't even have the funds to make a down payment, which used to be 20% but is now, I believe, just 5%. The most crucial component of housing affordability isn't the price of the house, but rather the mortgage rate, and mortgage rates a year ago were at an all-time low because people don't have the cash to put down 20%. Instead, they borrow the money. They are almost 7 years old now. The interest rate on a mortgage has doubled, which drastically lowers one's ability to purchase a home. As a result, housing prices will need to drop precipitously because this is the only way that anyone will be able to afford to buy one. Naturally, there won't be many houses on the market for some time because no one will build them because the cost is too high and they are unaffordable. And many homeowners don't want to move because they won't be able to buy another one if they sell their current one. This is somewhat mitigating the supply since they're kind of stuck because the mortgage on the new property can be double what they have on their present one. But in the end, I believe that demand and affordability will drive prices. As a result of rising mortgage rates, consumers will be able to pay much less, which will drive down prices significantly and eliminate home equity. Many people who are homeowners won't have as much equity, and it will have a significant psychological influence on their ability to save money, spend it, and utilize their property as collateral for a loan or other purpose. However, even though home prices will decline, owning a home will become much more expensive since, even if you purchase a home where the price has decreased by 20 or 30%, depending on where mortgages are located, your monthly payment will still be more than it would have been. If you had purchased the home a year or two prior at a lesser cost but with a somewhat smaller mortgage, insurance premiums would have skyrocketed. In fact, within a year, homeowners' insurance increased by 40%, and people are displaying proof of this. Insurance prices have increased much beyond that. Therefore, insurance premiums are soaring. And if something goes wrong with your home and repairs are necessary, the cost of labor, materials, and components will all go up significantly. A lot of things happened at the peak of the bubble, but everything needs to be unwound as the air goes out. Property taxes are rising, utility bills are rising, the cost to heat the house, the cost to air condition it. All of these things make home ownership increasingly expensive. As a result, fewer and fewer Americans will be able to afford to own a home, let alone buy one. Investing in gold in the USA is a time-tested strategy with several key advantages. Gold serves as a reliable hedge against inflation, offering protection for investors' wealth during economic uncertainties. The historical stability of gold, coupled with its finite supply, contributes to its enduring value. Investors often turn to gold to diversify their portfolios, as its performance typically moves independently of traditional assets like stocks and bonds. Additionally, gold is recognized globally as a safe haven asset, gaining traction during geopolitical tensions or financial crises. Its tangible nature, low correlation with other assets, and store of value characteristics make gold an appealing option for those looking to balance and secure their investment portfolios in the dynamic landscape of the USA's financial markets. As we conclude this exploration on the U.S. market collapse, investing in gold is evident that gold stands as more than just a precious metal. It's a timeless asset offering stability, diversification, and a safeguard against economic uncertainties. Whether you're a seasoned investor or just embarking on your financial journey, consider the enduring allure of gold. Remember, it's not just about holding gold. It's about holding a piece of history, a tangible store of value that transcends time. As you navigate the complexities of the financial landscape, let the golden glow of this metal illuminate your path towards a more secure and resilient investment portfolio. Have thoughts, opinions, or questions about the USA market collapse? Drop them in the comments below. Engage with our community and be a part of the conversation. Stay updated on our latest analyses and discussions by subscribing to our channel. Thank you for joining us on this golden journey, and may your investments always shine bright. Until next time, happy investing!